KOSPI rose 18%, the biggest single-day gain in the history of Korean stock market. In the 5 sessions before that, the same market had lost over 20%, 2 circuit breakers 2 days on a row, another first for this market. And around Seoul's financial district, there was already whispers of traders who lost everything in those days and took their own lives. So what changed in Korea's semiconductor industry in between? Nothing. The earnings that came out that same week are the best on record. Basically no change in the equity story. But one thing did change. In New York, a hedge fund finished liquidating, and on that fund's book sat SK Hynix. In 1998, Nobel Prize winners collapsed and shook every market on Earth, LTCM. What happened this week is a miniature of that event. Today, I'll walk you through what this fund is, how it died, and why a fund blowing up in New York ended up crashing a market on the other side of the planet. I'm Ko, and welcome to the Korea Report on Korea. Let's dive in. Leopold Aschenbrenner, former OpenAI researcher. In 2024, he wrote one essay about how AI could change the world, became famous off it, and named his hedge fund after its title, Situational Awareness. In the first half of 2026, the fund returned net 439%. Put $1 million in January 1st, you're holding $5.4 million by the end of June. By early July, it was running about $45 billion under management. He did not buy all of that with his own money. 3 prime brokers lent him debt to run the buck at about 4 times leverage. A thin slice of his own capital and a pile of borrowed money stacked on top. The bet itself was simple. Long AI infrastructure, short software. Buy memory, data centers, power, and sell the software companies that AI was about to eat up. And in that purchase list was the proud company of Korea, SK Hynix. On July 10th, Hynix sold $26.5 billion of stock in New York, the largest US listing any foreign company has ever done. Aschenbrenner's fund was one of 3 cornerstone investors in it. In July, both sides of the fund's position went wrong at the same time. The AI stocks fell, and software went the other way. Adobe rose 4.8% on July 28th, on a day the whole tech sector was falling. A long-short book is built so that when one side drops, the other side pays for it. When both sides go wrong at the same time, you're losing on the stocks you own and losing on the stocks you sold. The losses stack. And underneath all of that sat 4 times leverage, multiplying every dollar of your own money's loss. On July 30th, the fund sold its entire public stock book to Citadel in a single trade. Everything. Basically, the fund was dead. So why does one dead fund in New York drag a market on the other side of the planet down more than 20%? 4 times leverage. You put in $1, borrow $3, and hold $4 worth of stock. Same structure as buying a house with a mortgage. A small down payment, a big loan on top. Which also means your $4 position is sitting on just $1 of cushion. If that $4 falls 25%, your $1 is gone. So when the price falls below a certain level, your broker calls. The ones that lent you the money. They say put in more of your own money or sell the stock. That's called the margin call. And the key part is that the selling stops being your own decision. You don't pick the price. You don't pick the timing. You don't sell, but you get sold. And a fund with this size in trouble cannot hide. Because to raise cash or to unload positions this big, you have to call around. Brokers, dealers, other funds. And every desk you call now knows the same thing. A massive block of stock is about to hit the market. And they don't step aside. They know that, first, there's selling pressure in the market, and second, if the price gets slammed down hard enough, the fund in trouble will go down a death spiral. So they press the market down and keep pressing until the fund is dead. This has a name, predatory trading. That is exactly how LTCM died in 1998. A fund stacked with Nobel Prize winners, the smartest people in finance, with models that looked like they would beat the market forever. It ran at 25 times leverage, and for 4 years, it looked unstoppable. Then the Russian default broke its positions. The moment the market knew LTCM had to sell, the entire market stepped in front of it. It took the Fed pulling 14 banks into one room and $3.65 billion to make the selling stop. In finance, distress gets more expensive the moment it is known. The fact that you have to sell pushes the price down further. You can't know exactly who sold what, but foreign investors' trades on the Korean tape gives you the shape of it. Through July 23rd, foreign investors were buying Korea. $4 billion of net buying over 10 trading days. $1.9 billion on July 22nd alone. On July 24th, Aschenbrenner sent his mid-year letter to investors, asking them to commit fresh capital starting August 1st. Translation: he needed cash fast. From that day, over 4 trading days, foreigners sold $8.5 billion of Korean stock, $3.2 billion on July 28th alone. That day, the market fell more than 8%, trading froze for 20 minutes, and it froze again the next day. In the middle of the disaster, SK Hynix and Samsung Electronics reported the best quarters in their history. The market didn't give a shit. Hynix fell 10% on the day of its call. Samsung announced a record $63.9 billion of operating profit and still closed down. Record earnings and $8.5 billion of foreign selling in 4 days. Put those numbers side by side. Whatever was pressing the price down, it wasn't the numbers. Then came July 30th, the day that news broke that Citadel had taken over the book. The trade printed in New York hours after Korea had already closed. This meant that the overhang was gone. No giant sell order left waiting to hit the market. That day in New York, the Nasdaq rose 2.8%. Microsoft added $450 billion of market cap in one day, the biggest single-day gain on record for any stock. And Bloom Energy, the fund's biggest reported position, rose 26%. Another of situational awareness holdings, the neocloud Iron, gained 31%. The next day, Korea, KOSPI up 18%, SK Hynix up 30%, Samsung up 27%. And the foreigners were finally back, $5.2 billion of net buying in a single day. For these 8 days, what moved Korea's market was not earnings, not the equity story of a re-rated memory industry. It was whether one book in New York was open or closed. Nothing changed in Korea's semiconductor industry over the stretch. Not demand, not prices, not market share. What changed is that one book in New York opened and then it closed. That was it. People strongly believe this memory cycle is different from the old ones. AI demands long-term supply contracts. And yet, the market kept falling much further than the story allowed. It felt strange. This week, at least a small piece of the strangeness got explained. The full picture will come later, years from now. Someone will look back on today and explain it to us. Until then, we study and we have to keep investing. Because you have to survive to invest again. Thank you for watching the Koo Report on Korea. I'm Koo, and I'll see you in the next report.